In 2000, the dot-com bubble bursted. That resulted in significant changes to the first significant change to the capital market since 1929. What happened because of that? Investment banks would no longer would utilize IPOs to fund startups with multi-billion-dollar potential, and the need for private marketplaces at this point started to surface. Okay, next slide. This is a good example. Yahoo, and keep in mind that Yahoo, eBay, and Amazon, all of these companies did their IPOs. They were all startups. Yahoo had $1 million in revenue for fiscal 1995. Okay, yet it raised $35 million at a $350 million valuation. So it was a startup for all sense and purpose. Okay, Yahoo was. Yet you made over 200 times your money. Okay, next slide. eBay. eBay's another one. Valued for raised $63 million on its IPO at a $600 million valuation in 1998, and it multiplied by 36 times. Okay, that was never to happen again after those IPOs because there was so much risk that the investment banks refused to do it. So what happened next is in 2002 to 2004, the web user population had doubled again, and that provided the critical mass for MySpace, Facebook, and LinkedIn to all become to basically start the social media industry. Okay, next slide. Okay, this is the Facebook chart. You can see what happened. Facebook went on and it grew to 2 billion users as a good example. Next. Okay. In 2005, the first startup accelerator, Y Combinator, was launched. Within 10 years, the startup accelerators, this is what I found. I can't find any data on them, but I would imagine there's at least 500 to 1,000 of these things probably around the world now because of their business model and because they're the natural, after a company gets into an incubator, just to explain to everybody, an accelerator, once a company develops its product in the incubator, which there were 7,000 of them in 2016, they then graduate to an accelerator, and that accelerator helps them scale the model and helps them market their product and gives them advice on how to market the product. Okay? Y Combinator, the first in 2005. In 2007, the launch of the smartphone accelerated the potential web population. Why? If you see the blue line here, this is about what the web growth was back in terms of the early stages. And then, of course, when the smartphone was introduced, that took everybody. Since you didn't have to have a line, an actual telephone line, if you're in the middle of Africa or in the middle of South America, you could get on the web with just being on your phone. The demographics soared from 2 billion to 6 billion is what happened for the web in 2007. Next. Now, as I said to you earlier, in 2008, the need emerged for a private marketplace to come into being in 2000 when the dot-com bubble crashed, because what happened was the shareholders of Facebook and LinkedIn and some of these social media companies, they wanted to get their shareholders, their employees, liquid, and they wanted to delay going public. They didn't want to subject themselves to the public markets. So what happened is there was the second market started to emerge, Shares Post and Second Market, a private market. These markets emerged, and in 2016, there was $70 billion worth of securities that were sold by shareholders of private companies that are unicorns, large, big companies. Okay. Now, this slide here, in 2008, the smartphone app industry emerges, okay? And now, all of a sudden, the $10,000 investments in this new industry in 2008 through 2012 netted, $16,000 to $200 million. And the important thing about these were all angel investors could have put $10,000 into all four of these companies. That's what's interesting about this. The smartphone industry, app industry emerges. So next slide. from the end of 2020 to now, or the end of 17 through 20, there's going to be 1.4 million new apps that will hit the app stores. So the opportunities to invest in apps are abundant. Okay, there's plenty of investment opportunities still out there to invest and to make those kind of returns. Next slide. In 2010, DoddFrank passed. The DoddFrank Act was passed, and that passage and its enforcement changed the capital markets forever. It established criminal liabilities for the brokers, and that destroyed the financing and liquidity ecosystem for small and micro-cap public companies. Okay, because what happened is, prior to Dodd-Frank being passed, if you had a problem with your broker, you would take them to arbitration. Now, if your broker loses your money, they can be criminally charged, prosecuted, and imprisoned. This is the first time in the history of the capital markets this ever happened. So what that was, as a result, that's destroyed the ecosystem for small public companies forever. Anything in small public companies, and it's at the same time expanded the PE multiples and has reduced the volatility for large cap companies. Look at the next slide. Next slide. Okay. So you can see here, this is the low price stocks. They're in the blue here, versus the S&P 500 from 94 to 2017. You can see here that the trend lines start with the big stocks up red, the little stocks following them from the 2000. The 2000 market, the big stocks were at a premium to the little stocks. Then they both crash to 2002. Then the little stocks take off and are growing faster than the big stocks. They both crash again in 2008, 2009. And then look what happens. Then they both take off again. This time the little stocks take off ahead of the big stocks. But when after Dodd-Frank is implemented, look what happens. The spread has diverged to the biggest. This has never been like this in the history of the markets. Okay, it's a huge problem. Okay, next slide. So in 2011, the first TechCrunch disrupt event was held in San Francisco. Why was this significant? This was significant because prior to this time, the only way a guy could raise capital for his new business was to either go to New York on Wall Street and find a brokerage firm on Wall Street that would fund him, or go to Silicon Valley and find a venture capitalist. Now, with TechCrunch holding this event, TechCrunch is a division of AOL. These are big events, and they're held 4 times a year all over the world. So when they held this event, it marked the first time where entrepreneurs, entrepreneurs who were starting businesses, startups, and disruptors could attend events that were also attended by angel investors, venture capitalists, and regular investors. So now, with these events, 500 companies go to these events, 5,000 investors go to the events, and there's matchmaking going on at these events. Now, these events, since then, are now going on everywhere. Every major university in the United States now has an entrepreneurship program and is holding events like this. Every capital city in the United States is holding events like this. So there's now a way for investors and companies, startups, to congregate, and that basically has increased the amount of startups and investors who can participate, essentially. Okay, next slide. So in 2012, the Jobs Act comes along, and it lifts the bans that have been in place since 1933. It allows private issuers to advertise to raise unlimited amount of capital versus via Title III. So now a company can hang out a shingle and it can advertise online to raise capital. And the second thing is it also enabled a private issuer to raise $1 million per year from unaccredited investors from SEC-approved and regulated portals under Title III. So now, for the first time, an investor since 1933, an investor, your son, anybody at any age, can invest $100 into a startup company. Okay, for the first time since 1933. Okay, It also allowed the companies to raise up to $50 million per year from unaccredited investors under Title IV. Okay, that's another thing. Okay, now the problem with that is that was a great thing that happened, but the regulations that the SEC implemented for the Jobs Act to lift those bans were very restrictive. They restricted the company, the startup who wanted to raise capital, from doing any marketing activities prior to their going out and attempting to raise their first million from the public. Okay, so they're a company. They said, you can't advertise until you have your offering has been approved by the SEC, and you cannot prime the pump. So a business can't come out and tell all of its customers, hey, we're going to have an offering, in a month from now to raise capital. Go sign up so that you get the email. No, that's against the law. So the SEC restricted all that. Okay. They also prohibited the regulated platforms, the SEC regulated platforms, from selectively curating or recommending any of their listed deals over another. So the problem with that is if you have 1,000 companies listed on a platform, if there's 1,000 entrepreneurs that want to get capital from the public, the public's not going to go. The platform cannot say this deal is better than any other deal. So it's like going through a phone book, the white pages of a phone book, and figuring out. You can imagine you have a white pages with doctors, all doctors listed in it, and you had to go in and try to figure out what these doctors do, and you're going to try to call 1,000 doctors to see which doctor you want. That's ridiculous, okay? So those restrictions that the SEC created created a need for unregulated intermediaries, or what I call social investing communities, to provide the free content and education to enable the public, which has no experience in investing, to invest, and enable the public so not to have to sort through hundreds of thousands of startups, because the community could tell the public, hey, this is the one we like the best of the companies we're looking at that are on the crowdfunding platforms. Okay, so there was a real need for this was established when the SEC slapped those restrictions in place. Next slide. This is an article that I wrote about this in 2014 in October, saying, so I said, crowdfunding needs to get back to its roots. It needs to get back to where it was in the 1800s, because you have millions of people that don't know how to invest, have never invested, the masses. And what it needs is it needs these social investing communities, similar to what happened where Henry Lehman went out and got the community to get behind the railroads. That's what needed to emerge, as social investing communities. Next slide. Okay, so in 2014, the development of the digital social investing community models begun. Okay, the first one was Dynasty Wealth, and it was it focuses on startups with 100 to 1,000 times potential, and of course you have Trophy Investing, Apps Funder, and Sprout Up. These are all four of the original SICs that were on the drawing board back in 2014. Okay. Now, in 2016, the SEC lifts the 1933 ban to allow the public to invest in startups. Anyone and everyone can now invest. Okay. And so to give you an example, after that happened, I projected there was probably between 1 million and 2 million people in the United States and around the world. By the way, anyone around the world can invest in these. 2 million people around the world that invested $100, okay, as little as $100 in the U.S. companies listed on U.S. crowdfunding platforms. Okay, we project that number is going to drop to $10, the minimum investment amount in 2018. And we're going to be behind that happening. Next slide. Now, this is a significant event. In 2017, in the fourth quarter, Start Engine launched its Start Engine secondary market for the first time ever for shares of private companies with market caps of less than $1 billion to be liquid. As you recall, earlier I told you about the marketplace starting up with shares post and second market to provide liquidity to the shareholders of LinkedIn and Facebook. And they sold these companies, these private companies in 2016 sold $70 billion worth of shares, these big billion-dollar unicorn companies. There's 134 of them in the world, okay? So with Start Engine now said, hey, we're going to do the same thing that they did, except we're going to make the market liquid for companies under $1 billion market cap. So this, I believe, is the catalyst for startup investing to go mainstream by 2020. Why? Because investors much prefer a private market over a public to invest in emerging growth companies. Okay? Why? Because there's a lot less volatility. Let me explain this further. There's a much less volatility due to Wall Street's inability to manipulate. Okay? Now, here's what happens. Okay? So when you, everybody who's bought a low-price stock, I don't know if there's anybody in the world who's seen it go up before it goes down. I mean, no one's bought one just simply goes from where you buy it to it going up and multiplying in value. They always go down. They always become volatile before they go. Okay? And why is that? Because Wall Street, with their market-making opportunities, has to jigger the market and shake people out of the market. They have to create volatility so they can shake people out of the market. Okay? And people hate that. People hate to buy a stock. To give you an example, buying a speculative small price stock is different than one going out and buying a raw piece of land out in the desert or outside the outskirts of a city, and the guy buying that raw piece of land because he and his wife believe that someday an interstate's going to come through this area. So, honey, let's go buy this 100 acres out here. We'll pay $10,000 for it. We know that, hey, eventually the population's going to grow. There's going to be interstate coming through. Let's buy the land. Let's put a sign up that we're going to sell it for 5 times what we paid for it. Put a phone number on, and let's just wait for the phone to ring. Whatever it takes, let's wait. So basically, that's the same mentality that is going to work in this private market. So now a guy can go in and buy the shares, buy $1,000 worth of a startup company that the analyst says, oh, I think this thing could be worth, this dollar share could be worth $100 in 5 years. Now he can buy $1,000 at $1 a share, and he can go post it at $100 a share listed on Start Engine and wait. Okay, that's why the whole market's going to change for this, and that's exactly what's going on with the big market. What happened in 2008 when those two markets opened up to take care of the big companies. They list their shares, and the large investors come in and buy them from them. Okay. Okay. Next slide. Okay. This is the 2017. Here's the significant developments that occurred for the SICs the development was started in 2014. First of all, the freemium revenue model for the SICs was perfected. Okay. Now, what do I mean by that? Okay. Now, keep in mind that Facebook, when I discovered that the SICs were coming in 2014, I realized that I was in the position to develop the model see the model developed for the Facebook that would eventually merge with this industry. In our video, Dynasty Wealth video in 2015, we said that this industry, the SIC industry, was going to be as big as the social media industry, and the companies that comprise this industry would have equivalent market caps to the size of the industry, the social media industry. Okay, so why is that important? Well, first of all, there's a lot of reasons, but the point is that the simple reason why it's going to be as big is because everybody's going to get into it, and Amazon can much easier sell $10 in a startup as it can a book. Okay, so if Amazon's going to get into this business eventually, that's what's going to happen. The big digital companies, Facebook's going to try to get into this business. Social, why? Because they can basically sell shares in a startup. They don't have to deliver any. They don't have to send a drone in to deliver it to your doorstep. I mean, it's real simple. So this is going to be a huge industry. Now, with this, I realized that the Facebook. Now, so let's talk about why this is significant. About what happened with Facebook. So so remember that the first social media company that was founded was LinkedIn in 2002, December of 2002. Facebook was founded in February of 2004. The founder of LinkedIn, okay, was a guy by the name of Reid Hoffman. Reid Hoffman and Peter Thiel, who spoke at the Republican convention and who was the guy who made billions on Facebook, they were co-founders of PayPal. So when PayPal was sold out to eBay, Hoffman started LinkedIn, and which was the first social media company. Now LinkedIn then went on, okay, and was building its business. Hoffman heard about Facebook emerging in late 2003 and said, hey, he saw the model was going to work, and he sent Thiel in to invest the $500,000. So Thiel was the first angel investor into that financed Facebook because Hoffman knew that Facebook was onto something. Okay, so I knew when I founded Dynasty Wealth and this industry that I would be in the position to either see the Facebook that emerged. Because so let's face it, Dynasty Wealth is the LinkedIn of the model. Dynasty Wealth is a niche model. LinkedIn is only for 5% of the population. Everybody who's a businessman or selling insurance or whatever in the world is with LinkedIn. Everybody else in the world is using Facebook. So knowing that Dynasty Wealth, which focuses only on those companies that can multiply by 1,000 times and only extremely wealthy investors as its members, I figured that, hey, Dynasty Wealth was the LinkedIn. I was going to be able to see the Facebook of the industry, okay? And it's very important for everybody on this call so we understand that's the position I was in. So the next point I'd like to make is Facebook. When Facebook was founded, it didn't generate any revenue. In fact, when Facebook did its IPO, nobody really knew how it was going to generate IPO. That was 8 years after it was founded. Okay, so what happened? The significant development for the SICs happened in the fourth quarter of 2017. It's called the freemium revenue model. Under the freemium revenue model, okay, this is how it works. If you go to, if Disney World were to come out and announce that they have, they're going to give a free week this year. A certain week this year is going to be for free. You can ride all the rides for free. On that week, you're going to have 10 million people show up at the park. You're going to have people living and staying in hotel rooms 100 miles from Orlando waiting to get into the park. Okay? So what's going to happen when that happens is you're going to have all those 10 million people show up for the free rides, and they're going to find that, hey, there's not enough room here for 100,000 people to ride in Disney this day. So what does Disney do? They sell them a fast pass on that day. So if those of you who have not been to Disney World in a long time, Disney World now has a fast pass system that enables you to basically pay to cut to the front of the line. Okay? And that's exactly what our model is. We're going to basically give, the SICs are going to give these things away to the public and let everybody invest $100, as much as at the point where we have 5 times more people participating than there are number of subscriptions available, memberships to pay, then we're going to start charging, okay? And then there'll be different fees. That's the way the freemium model works. So we figured that model out, okay? So the other thing that happened is we developed the seamless investments to funding systems the ABC, what I call ABC, was completed, because if you go to Trophy Investing, or you go to AppsFunder, or you go to SproutUps right now, you can be a business that's looking for capital and you can automatically sign up, or you can be an investor who wants to invest in those businesses and automatically sign up. So the system is now fully automated and seamless, okay, in terms of the ABC system, okay. So what happened with that, we completed the construction of the 4 key SICs by the end of December, and we also established the Social Investing Communities Network, okay. So these are all the significant developments that happened for the SIC. So all that hard work that went in 2014 it started in 2014, culminated with these significant things occurring in the second half of 2017. Okay, next. Okay, here's an example. So this is the Social Investing Communities Network. Why is that important? Because it's capable of funding all rounds and liquidity for startups. So to give you an example, so the value of $10,000 invested in Uber's fundings in 2010 to 2014, if you'd invested $10,000 in its founders or its seed round, it would have grown to $125 million, and there was 125 investors who could have participated in an average of $10,000 apiece. If you'd invested in its Series A round, hey, 1,100 investors could have invested, and they would have made $10 million apiece on $10,000. Okay, same thing is on the Series B round. 3,700 investors would have each made $1.8 million on $10,000. So you get the point. The point here is that with the SIC and the Social Investing Communities Network, okay, what happens is that Social Investing Communities Network can now go back to the slide. We went too far. Okay. Important point is, right now, the system that is used to fund companies is archaic. Because here's how it works: you don't have any investment bankers who will do all 5 of these rounds. You have some VCs that will do maybe the first and second round. Some will do the Series D round. So you don't have any venture capital companies that do these rounds, that will do every single round. Okay, so the risk is, for any investment, for any entrepreneur or any investor, if somebody comes in and puts the money in for the $1.25 million in, and someone doesn't come out and finance the next round. Okay, so Uber had to raise capital very quickly. October 10 to February 11, 5 months later, they were growing so fast they had to raise capital, another $11 million, 5 months after they raised that 1.25. They were lucky to get all this together, and of course, a year and a month later, they raised $37 million. Okay, in November of 2011. That's not possible under the current system that's been in place forever with the using venture capitalists. But it is with this SIC, Social Investing Communities Network. Go to the next slide. Okay. You can see here the members of the here's the members, okay, of the SIC. So here's an example. Dynasty Wealth participates in all seed rounds and provides shareholder liquidity. Okay, that's what it does. That's what its job is. Trophy Investing invests in all rounds, not necessarily seed, probably not seed rounds, and shareholder liquidity. So Trophy Investing is going to provide the liquidity and the secondary rounds for those companies that Dynasty Wealth finds in the seed round. AppsFunder is a seed round company, seed round SIC, and Start Engine is an SEC regulated platform. So just so you know, AppsFunder is providing the seed rounds of up to $100,000 in seed round financing for any app that applies for and gets listed on an SEC regulated portal. SproutUps is providing up to $100,000 of seed round financing for any new business that gets approved for listing on a regulated SEC portal. That's what those two guys do. So they're not raising $1 million. AppsFunder and SproutUps are going to raise $100,000 per company from 10,000 investors. Okay. Trophy Investing raises money from investors from $100 to $1,000 per company. Okay. Start Engine is part of the SICN because it happens to be the SEC regulated platform, the first one that we're all doing business with. Okay. Next slide. So here's a good example. SproutUps is going to be SproutUps is a key SIC because you can see here you had invested $10 in Uber's founding rounds. As of December 31st, this is what it was worth: $135.11, $2,280. Why is that important? Because they provide SproutUps can provide startups with access to millennials, and that allows the millennials, the startups, to get access to social media. Why? Let's say you have any company that has a product that addresses the billions of millions, hundreds of millions, or whatever they are, billion millennials on the planet, needs to go into SproutUps to do an offering. Why? Because they want to get in their seed round 10,000 millennials to invest in them. Why do they do that? Because those millennials are going to go spread. They're going to become the advocates. They're going to start selling. They're going to tell all their friends, hey, I just bought into this. I put $10 into this hot startup. You got to see what this is all about. And they're going to spread the word. So do the math. 10,000 times, times 10 is 100,000. 10 times, and now all of a sudden, the startup has 1 million people that want to download its app or buy its product, whatever it's doing. Okay, so this is a key. SproutUps is a key SIC for the social investing community. Okay, next slide. Here's the founding members of the Digital Business Development Ecosystem, what I call the DBDE. There's obviously Dynasty Wealth, Trophy, AppsFunder, SproutUps. Cannabis is one that's coming that we have on the drawing board. It's a niche for the cannabis industry. The cannabis industry needs this. It's going to be massive. Cannabis is going to be another significant SIC. Crowdfund Cures is another one. This is going to enable the masses to provide funding for those diseases which are in their family of origin. So let's take sickle cell anemia. If somebody has sickle cell in their family and origin, and they're a millennial, 20 years old, and they can basically join a community that funds scientists who are looking for cures by buying a stake in those companies, of course they're going to want to do it. Okay, Green Ventures is another one where people are looking at how do we save the planet? What can we do here? Recycling, whatever it is. Okay. So these are all niches. JustGetOnline.com is an affiliate marketer, which is disrupting the entire network marketing industry. But this is interesting. 40% of Amazon sales last year were sold by affiliates, ran through affiliates. So JustGetOnline is going to be the affiliate marketer that's going to market subscriptions and memberships to all of these, and also it's going to market the digital products and services of those startups that are applicable to all these SICs. Okay, Phantom Business Solutions is a digital accelerator that we're working with. Startups News is a provider of content. Startups News. WFN1 is a video news reporting. WFN1.com is currently basically airing shows about startups on the iHeart Radio network. They're going to go to video. We're going to go to broadcasting with them. But WFN1 has the potential of being the home shopping network of the entire of startup investing. So, what's going to happen, all you ladies and gentlemen who are interested in investing on this call, hey, what's going to happen is startup investing. We're going to be you're going to be sitting in our rocking chairs, soon, watching the Home Startups Network. Okay, is what we're going to do, which is WFN is going to build, and people are going to be buying startups right off their TV is what's going to happen. Okay, and of course you have again Start Engine, which was the first the first SEC regulated platform is also on here. Next slide. Okay, so here's an example. These were 10 startups. Now, the system was implemented. We launched all this stuff, and right now you can go into trophy investing. You can go into AppsFunder. You can go into SproutUps, and you can invest in two or three companies now. And we're not, we're still trying to find our way in terms of the best marketing for this, how do you really leverage social media. We're working on that around the clock. We'll get that figured out. That's just part of perfecting your model. But it's interesting that the two of the startups that are listed on those sites rank number 2 and 9 of all the startups that raised the most capital of all the crowdfunding startups on all the platforms for the month of December. Okay, they rank number 2 and 9.